All right. Hi, everyone. How's everyone doing? Happy Monday and welcome to tonight's Tastemaker series session. Thank you so much for joining us this evening. Drop me in the chat if you're tired from daylight savings. Let me hear it. My name is Monica. I'm the editorial director from the Monday Girl team and co-host of TJM podcast. For tonight's event, we are going to be talking about all things money. So if you really don't understand investing and feel very hesitant to put your hard-earned money out there, this session is for you. I feel like I've been waiting for this session for the last couple of months. We spoke with Jessica I guess it was like 4 months ago, and we learned so much. So we were so excited for tonight's session. Like I mentioned, our guest tonight is full of incredible tips to help you change that. I'm so excited to introduce a good friend of the MG team, Jessica Moorhouse, money expert, speaker, content creator, and host of the Money More podcast. To this day, TJM podcast episode with Jessica, The Pressure to Be Rich in Your 20s, episode number 2, if you want to check it out, is the most downloaded episode of the whole season. Jessica, thank you so much for being with us tonight. We are really, really excited to have you here today.
Yay, I'm so excited to be here. I feel like this is the perfect time to start talking about investing because, it's November and like we were chatting before, we're entering the holiday season. And what that means is people are just going to spend money. So why not spend that money in the stock market? All right. Hello and welcome. I'm so excited to be here to talk about investing today for a wealthier tomorrow. Now, although investing can seem complex, it's something I hear often, it does not need to be. And that is why in this presentation, I'm going to share the key things you need to know to start investing and building wealth, but in a language that you can actually understand. Now, I don't know about you, but for me as a financial educator, the past almost 2 years now, they've been very intense. So I have personally never fielded so many questions about investing in my entire career, and I've been doing this for almost a decade. So to give you a refresher, this is what has been going on in the stock market the past few years. And I think this is probably why a lot of people are asking me questions about investing, and maybe yourself thinking, is this the time that I need to, should I figure this kind of out? So this is just a representation of the overall stock market. I'm using a particular index, the S&P 500 total return. As you can see, there was that peak right there, the pre-pandemic stock market peak in February 2020, when everyone thought everything was going to be just fine. And it wasn't. We had a market crash, and that's where you see that big dip happening in March 2020. That's when I think if you're like me, that this is where it all kind of starts spiraling for lots of people. I heard so many stories of people freaking out, cashing out all of their investments, or thinking about starting to invest, but then being too scared to, or thinking about starting to invest, but not knowing where to start or what to invest in, and then just buying a bunch of random stocks and hoping for the best, which we also do not want to do. As you can see, a lot of people panicked because everyone does when there is a market crash or a correction, which is just a smaller dip. It's still a dip. Everything has been pretty peachy ever since. As you can see, even though there's been lots of little ups and downs, overall, there's been just a big overall up. But most recently in October, if you read the news or you talk to people about investing, you'll see that there was a little bit of a market dip in October. But again, and people, I honestly, so many questions I was getting from people were like, oh my gosh, I'm losing so much value in my investment portfolio, or I don't know if this is the right time to start investing. And guess what happened again? It went back up. So we're going to talk a little bit more about why we don't need to do this market timing. We don't need to worry too much about the ups and downs of the market. The key thing is to just get into the market. That is the most important thing. Now, before really diving into investing, because there is a lot to kind of share, I do actually want to talk about a really important topic, which is mental health and wealth. So I want to kind of share a few stats with you. So 48% of Canadians say they've lost sleep because of financial worries. That seems pretty on that seems pretty accurate to me. 50% of Canadians feel that their level of debt is causing them stress. 40% of Canadians feel that their level of debt is negatively affecting their mental health. So, as you can see, your financial situation has a direct impact on your mental health and overall well being. And if you're not in the right frame of mind, well, then doing things like planning for retirement or starting to invest or looking into your employer's pension plan or group RSP program will obviously be very low on your to do list, even if they could, in themselves have a very big positive impact on your financial situation. In other words, mental health and wealth are very symbiotic. They go hand in hand. They're very interconnected. And when you are in a good financial situation, it will have a positive impact on your mental health. And having good mental health could then benefit you and your financial situation. So, how do we fix this? Because it seems kind of like, wait, I don't know how this is going to work. So, number one, this is actually something I've been saying, especially a lot during the height of COVID. And this is something I've also done. I'd say first, if you don't feel like you are really capable to make some good moves in your financial situation, sometimes the best thing you do is seek professional help. So I personally have a therapist. I actually started seeing one during COVID, and it was the best thing I ever did because I did have a lot of fear. Even me, who knows all of this stuff, I had a lot of fear about what the future held for me because I'm self-employed. I'm like, oh gosh, is this it? Is this the end for me? And so for me, that was a really big help. But it could also take the form of working with a financial counselor or a credit counselor if you feel like you don't know how to organize or manage your day-to-day finances or structure or budget or take control of your debt situation. There's nothing wrong with putting your hands up and saying, I don't have all the tools I need. I need some help, because there's only an upside to getting professional help. It will only help you get on the right track with you and your life and feeling more in control, which is a really important thing. But a second thing I'll say is I think shifting your mindset to one that is focused on possibilities, opportunities, and solutions is so important. So if you're in what's called a scarcity mindset, you'll only see problems and not seek solutions. So you'll be stuck in a place of always saying, no, I can't, or blaming others or your environment for your situation. Although circumstances can have a big impact on where you're at today. I'm not like, of course, we all have, different circumstances. Some of us were lucky to have, some privilege or some generational wealth and things like that. So we're not all starting at the same starting line, and we've got to kind of recognize that. But that should not still deter you from being able to see, how can I fix my situation? There are some things that I can take control of, that I can do to improve things. So one example that actually just happened the past couple of days, I posted an Instagram reel like a week ago, and it's been getting some traction, I guess. And it was just a really, I thought, just, not offensive kind of reel that was focused on me showing you the power of compound interest and starting investing early. So I gave an example. If you invested your money, $1,000, and then continue to invest $1,000 every single month for 20 years, you'd end up with about $500,000. And then if you, increase that time horizon to 30 years, you'd have over a million, like I think it was $1.7 million. I didn't think it was anything crazy. Anyone can, put in whatever numbers they want into a compound interest calculator and get whatever number they want. I just wanted to keep things simple. And also it was to like that Rent song. So I wanted it to be that specific number that was in that Rent song. But at first, when it wasn't getting too much traction, I got lots of nice comments being like, oh, this is great. And lately though, in the past couple of days, as more people have been watching, the comments have been a little negative. And luckily, I know what I'm doing. And so I didn't feel offended by some of the comments, but it was fascinating. The people just could not get over the idea of having $1,000 per month to invest. They're like, how on earth am I supposed to have $1,000 extra to invest? I've got responsibilities. I've got bills. I've got a family. It's ridiculous. Do you not understand how people live, et cetera, et cetera? Now, I was just saying, well, again, this is just an example and you don't have to do $1,000. But I was actually kind of shocked that they immediately discounted the idea of ever having $1,000 extra per month to invest. Like the reason I was comfortable using that number is I work with one-on-one clients and they can afford that. I can afford that. I know lots of other people that can afford that. Not everyone can afford that, but I know it's possible and it's not a crazy number. Like when you think about it, it's only $12,000 per year. Like that's not a crazy amount, especially if you are, at a good position in your career. Like I'm in my mid 30s. I couldn't afford that in my 20s. In my 20s, I think I can only afford like $200 per month. And even then that was like it was a big deal for me, but it was crazy to think that they were so focused on that scarcity mindset. Like I'll never have enough money. Like I don't have that money now, so I'll never get that money in the future. And instead of trying to, really think about how can I get more money? How can I increase my income? How can I improve my circumstances? So instead, I kind of, think why not, instead of really just like living in that negative scarcity mindset, try to, do something different and get into an abundance mindset. I'm not very woo-woo and I'm not really into the idea of manifestation, but it is kind of along those lines and it does work. But it's really just about shifting whenever you have a negative thought or you want to blame something or you want to say, I can't, I don't, I will never, shifting it into a more problem solving and finding solutions mindset. So, you don't, if you feel like you don't have enough money left over to invest, well, that shouldn't be the end of the conversation or the end of the thought. You need to figure out, okay, well, what can we do so we can have more money left over after we get paid to invest for our retirement or whatever our goal is? And that could look like, okay, well, we can rework our budget or make a budget in the first place. We can look into asking for a raise. Maybe we've never asked for a raise or a promotion. We could look for a higher paying job. I mean, that's typically how most people earn more money. They don't usually stay at their employer. They usually go to another employer, and you can usually, have a significant pay bump by switching employers. You can get a side hustle. That's what I did for like 6 years on top of my day job. I was never really earning too much money. I started at like 30,000 back in 2010 for 3 years. Then I think it was 40,000 for a year, and then 50,000 is what I earned at my last job. And I was living in Vancouver and then Toronto, very expensive places. But I was able to make it work because I knew I had limitations with that one income. So I had a side hustle. My side hustle is now my full-time job. Not saying that everyone needs to do what I do, but I'm just saying it's about being open to new possibilities and opportunities and not just saying, I can't. It's like, well, if that's your mindset, then you can't. Anyways, that's my little 2 cents on that. So it's really important to have that mindset piece before really diving into the practicalities of investing. So one last thing I do want to mention though, another way to think of to motivate yourself to start managing your money properly and also investing is think of it as a form of self-care, because that's really what it is. It is a way for you to not only take care of yourself better today, but also you're taking care of future you. So it is like kind of the ultimate form of self-care. So making it a priority will only benefit you today and tomorrow. So now I want to talk about saving versus investing, because I talk to so many people and we do use those terms interchangeably, but they are very different things. Really, we should stop saying saving for retirement or, oh, I'm saving to afford this really lofty goal that you need to invest your money for. We should be saying investing, but just so you know, people just use those terms interchangeably. So first, when it comes to saving, what does that mean? That means literally saving and putting that cash, so it should be liquid cash, into a savings account where it will remain liquid and easily accessible. So saving is meant for your short-term goals. I think that's the really key thing to remember. It's meant for your short-term goals in which you may need to access that money in either a hurry or in a short time frame. So an example is your emergency fund. That should always be liquid just cash in a savings account. If you're saving up for a trip and that's going to happen in a year, or saving up for tuition if you want to go back to school, saving up to buy anything in the next year or so, that should stay in cash in your savings account. But for when it comes to investing, what that means is you are using cash to buy an investment asset such as stocks, bonds, mutual funds, ETFs, real estate, cryptocurrency, even though I've got my feelings on that, with the intent to grow that money over time. So investing is best for longer term goals, such as retirement or saving up for a down payment on a home, anything that is basically 5 years or more, or maybe even 3 years or more. Now, even though this sounds pretty simple, you wouldn't believe how many people are making the mistakes with this. So this is a common thing I see. People, I do sales calls for my investment course. And one thing I ask, like, are you currently investing? And one thing I hear often is, oh yeah, I'm investing in RRSPs, or I'm investing in TFSAs. I'm like, oh, great. So like, what are you investing in though? Look at what's in that TFSA, what's in that RRSP. And they're like, I have no idea. And most of the time when they take a good look, they're not investing. They literally put cash into those accounts. So a TFSA and RRSP, those are just accounts. Those are just, a basket that you could put whatever you wanted. You could put cash in there, or you could put investments in there, lots of different types of investments. They are not an investment itself. And so it's really important to understand saving versus investing. And if this is kind of freaking out, like I have an RSP, I have no idea what's in there, make sure to check out what's in there, make sure it's not cash. So I want to give a few practical examples, speaking of compound interest, about what the difference can make in terms of saving versus investing. So here's an example of saving. So if you started with $1,000 and you saved an additional $500 per month at 1% interest, which you can get at a few banks, if you were to just put that into a savings account for 40 years, you would end up with $296,149. So you would have personally contributed $241,000, and you would have earned about $55,000 in interest. Not bad, but 40 years, you would expect to have a little bit more cash in the bank after doing all that work. Well, since that's a long time horizon, you should be investing that money. And here is an example of what could happen if you instead invested that money. So if you started with $1,000 and saved an additional $500 per month at 8% interest for 40 years, you would end up with $1.6 million. So you would have still contributed the exact same amount, which is $241,000, but you would have earned almost $1.4 million in growth. So that is why it makes a big difference, saving versus investing. But with that said, there's another two things that I really want to clarify, because I feel like this has been going rampant on things like TikTok and Instagram and Reddit. It's the difference between investing and speculation. This is one of my favorite memes, so I always have to use it in presentations. So let's talk about why is there this rise of speculation? What does it actually mean? So speculation, it's largely been fueled by things like Reddit, Twitter, TikTok. And what it really means is gambling, in my opinion. It is not true investing. It is things like, you're investing in meme stocks like GameStop or cryptocurrency, but you don't really understand all the risks involved. And when I say cryptocurrency, again, I have my feelings about that. I'm really more focusing on like all of the new crypto, things that are coming out. Like, gosh, I can't even keep up with them. I think there's one that's like Shiba Inu or some other dog one. They keep on popping out. In my opinion, so many of them are scammy. And that, in my opinion, is speculation, because the reason that lots of these people, and usually they're young investors, are investing in these, investment products is for a couple of reasons. First, the biggest reason, and this is crazy, is FOMO, just fear of missing out, fear on missing out, and feeling that, oh, I could have had that payday, I could have gotten rich quick, like we all still as humans want for some reason. I think another thing is just also seeing all these people touting how successful they've been with this practice, even though you actually have no idea who these people are online, no evidence that they did actually get rich off doing these things. So although there may be some true people who got rich from speculating, it's important to remember that people are quick to share their wins. Rarely do they share their losses. Why would anyone want to share an investment loss? No one's going to want to share that I lost hundreds of thousands of dollars with Dogecoin or Dogecoin or whatever. They're going to just talk about their wins, and that's going to encourage other people to get into it. And to me, that seems very similar to a pyramid scheme. So it's very important to understand the difference between investing and speculation. So investing is not gambling. It means you are taking calculated risks. You understand what risks you're taking. And again, you're in it for the long haul. You are not doing anything to basically get rich quick, because get rich quick, I'm sorry to say, it doesn't, no one gets rich quick. That's just not the way. Just like no one's an overnight success. It took them 10 years to get there. No one really gets rich quick. That's if they are, that is 1 in a billion lucky chance. So let me kind of talk about what investing is and what it should be. So I don't want to scare you off, because I know I talked a lot about speculation. And again, it's just because I see that's all the time promoted on social media. I want to steer you away from just making those mistakes. I don't want to scare you off investing. I actually want you to encourage you to invest, but in the right way. Basically, speculation means it's entertaining and there's a lot of buzz and there's a lot of stress involved. Yeah, that to me is a big red flag. In my view, investing should not be entertaining. It should actually be boring. And I actually like boring investing. I like being boring. So not only that, though, stop thinking that you need to get rich quick, because in my opinion, and there's so many great strategies and evidence to this, instead of trying to get rich quick, why not think of it a bit differently, getting rich slowly but eventually. That's kind of my little mantra. It's like, I'm not rich now, but I'm getting rich slowly and eventually. I'd rather be eventually rich than trying to get rich quick and then never actually getting rich. So that's kind of my 2 cents on that. So when we're talking about what does investing mean, what does it look like, what are some best practices, these are my top 4. So when we're talking about investing, it's really about starting investing as early as possible. I think we've all kind of heard that, but it's really one of those things. Like, again, I mentioned, like, I started investing in my mid-20s with only $200 per month, which seems like nothing. We'll cut to 10 years later, and those little contributions compounded over a decade. And now I'm really glad I started investing as early as I did. Another key principle to investing is regularly investing. You can do lump sums, but I think for most of us, especially if you have a regular 9 to 5 where you get, a regular paycheck, it's so much easier just to contribute to your investments every time you get paid. So I used to get paid biweekly. Biweekly, I would put money into my investment account. Just having that habit, making those regular contributions, and that's also a practice called dollar cost averaging, is such a great practice to instill, not only just to create that habit, but again, you're consistently buying into the market at different points. So even if there is a time where the market was low and, rather the market was high, and so you bought high, you may, when there's like a market dip, be buying during those low points, and it all kind of balances out. Another really important thing when it comes to best practices is do not panic and sell your investments when there is a market downturn. That is literally the worst thing you can do. What that's called is locking in your losses. So when people talk about, and sometimes I still see this from people talking about, oh, I lost all my money in the recession. The only way you can lose your money if there's a market crash or a recession or something like that is if you sold off your investments. I think I might have, I think I have some, I have some charts in a bit. So I'll show you actually, talking a little bit more about market timing. But if you just stayed in the market, you could ride out those waves. But if you decide to sell, especially when things are going down or at the bottom, you're locking in those losses. You will lose money. But if you literally didn't do anything, you would be fine. And lastly, don't time the market. Stick to your plan. I'm going to talk a little bit more about what an investment plan looks like. But again, it's not about finding the best time to get into the market or best time to contribute to your investments is really just about creating a practice, doing it consistently, and being boring and consistent. Like that is really the best way to be an investor, is really to just like not overthink it. Now, when I talk about overthinking, because we will have another crash, we will have another correction. There is going to be other financial, hard economic times. So that's just part of the natural life cycle of the stock market. So don't be afraid of it. It's just like, that's just how it goes. One thing when these things happen, and this is something I quote I revisited often during March 2020, when everyone was freaking out, thinking it was like the apocalypse, is this quote by John C. Bogle. So he's actually the inventor of the modern day index fund. So when these crises come along, the best rule you can possibly follow is not don't stand there, do something. That's something that we feel like we have to do. Don't stand there, do something. Instead, don't do something, stand there. So what he means is really not panicking, not making really expensive or long-term decision based off a short-term emotion, and doing nothing, just sticking to your plan, still consistently investing in your portfolio, not feeling peer pressure or FOMO, and not letting those really direct or guide your decisions. If you need something, I put this on a post-it. It's like just literally do nothing is sometimes the best thing that you can do. I feel like that's also an overall theme of watching The Crown. If anyone's a Crown fan, it's like the Queen does nothing, but also that has a lot of power and weight to it. Now, to kind of go along with that, I do want to talk about this is something I get asked all the time. Is now a good time to invest? And I think what people actually want to ask me is, if I invest now, will I lose all my money? Or if I invest now, will I make good returns? The truth is, quite honestly, I don't know. And neither does anyone else, because no one has a crystal ball. No one can predict the future. And that even includes the most skilled financial analysts on Bay Street or Wall Street. They're all just guessing. Sometimes they get lucky and lost the time. They are completely wrong. I know there's so many like money experts and financial analysts that every year consistently, they're predicting a doom and gloom crash. And, they'll do it every single year for 10 years. And 1 year they'll be lucky. And then they'll be like, I told you so. That doesn't sound like to me, that's just luck of the draw, but that's not something that I'm going to put money on, basically. So what's really important is no matter when or how you invest, there will always be some level of risk present, but that really shouldn't scare you away from getting started, especially getting started right now. So let me show you what I mean. I've got some graphs. So this is a historical chart. This is showing the overall US stock market, but if we were to look at the overall Canadian stock market, it would look very similarly. So this is just from about 2003 all the way to 2021. And just depending on your age, so I'm a millennial, I'm 35, and this was when I graduated university in 2009. It was terrifying. My first kind of introduction to investing and the financial markets and personal finance in general was when everyone and every headline was, everybody lost their money in the stock market crash. There's no jobs, et cetera, et cetera. It was a terrible time because it was the worst that we had ever seen since the Great Depression. And yeah, lots of people freaked out. And what did? They cashed in, they locked in their losses and they lost their retirement funds. But if they had literally not touched anything and just, kept on investing, well, first off, they probably would have made it a lot of money because they're buying all of those investments at really low prices, at discounted prices, because they're all valued very low here. And then if they just rid out that wave and rid it out until like now, which when you think about it, it's only been like 12 years since that time. Look where we are now. This is literally where we are now. And if you were like, what is that little blip? That is literally the crash of 2020. That's it. Like, it looks kind of actually not very big, especially compared to like the big one of 2009. But the other thing that's also important to kind of recognize is There's red, which represents all of the market downturns, and there's green, which is all of the upswings, all of the recoveries. There's obviously a lot more green than red. And the important thing to remember is historically, the stock market will always go up. It will go down too. It will always go down at some point, but it will always go up. And if you're one of those doom and gloom, people that's like, oh, but what if it doesn't always go up? I mean, then then we're going to be in a zombie apocalypse. And it's like, this is going to be the least of our worries. Your investment portfolio is going to be the least of your worries. So instead, I'd like to have a positive abundance mindset to think that I think we will continue to go up. But the really important thing is to just not freak out and just stay in the market. So to give you an idea of how I reacted, because of course I'm human, this was my portfolio from January to December 2020. The yellow line was the stock market and the blue line is me. So it was very difficult because, I have those scarcity mindsets. I had those freakouts too, just like everyone else. I really want to just hit pause on me contributing. I didn't want to contribute any new money. I was worried that I wasn't going to earn any new money. I didn't know what was going to go on with my business. But I'm just like, you know what? Let's just stay consistent. This is what you tell everybody, take your own advice. And that's exactly what I did, even during this really scary time right here. And I just was consistent. And as you can see, well, it has been consistent. And then it started going up consistently. So I was patient, let it go up. And then there's a big point where I made a little bit of a bigger deposit here near the end of the year. And this was just the end of December. And that was a year ago. My portfolio has grown even more because I've stayed consistent, even with the ups and downs. Again, like we had one just in October, people freaking out. And it's really just about recognizing those feelings and not doing anything about them. Now, let's talk a little bit about, okay, what are some practicalities? How do we actually get into this investing thing? So the thing you will want to start with is what's called an investment plan. It's actually something that I feel like most people totally forget about, which is what I'm trying to kind of educate more people about. Before investing your first dollar, before investing a trading account or opening up a trading account rather, you need to have a plan, which makes sense. I mean, before really doing anything with your money, you should have a plan, which is your budget, your spending plan. The same thing should go for your investments and wealth building. So what does that mean? So what did I write here? How do I make an investment plan? Okay. So these are the questions that I hear often. How much should I start investing? How much should I continue investing regularly? What should my portfolio asset mix look like? Where do I start with all of this? These are the questions that you need to answer before you invest any of your money. And the place that you're going to start is number one, investment goals. So similar to, again, like your budget, like what are we saving for? What are we investing for? What are we doing and why? What is the why behind it? So when you're creating a solid investment plan, you need to figure out your investment goals and their amounts, their specific amounts. So since we're talking about investing today for tomorrow, most likely your investing goal would be, financial independence or retirement, which simply means, financial independence specifically means having a big enough nest egg that you can stop working and you can live off your savings. Retirement, basically the same thing, though typically you won't hit that until about 60, 65, 70. I mean, you can retire early, of course, but those are the kind of the general ages that people choose to retire at. And also when you're retired, there's other kind of things that you can draw on in terms of your income, such as maybe a private pension plan from work, your RIF savings. So that is basically when you retire, you convert your RRSP to a RIF. We're also going to get Canada pension plan payments and old age security payments and stuff like that. So you can, of course, have other investing goals, like besides financial independence and retirement. So if you're saving up for a home, you're probably going to want to invest for that. If you want to go back to school and it's going to be a few years down the road, may make more sense right now, especially with low interest rates and high inflation, to invest. Buying a rental property in down the road, if you have kids, college fund, things like that. So it is actually totally fine and normal to have multiple investing goals. I think a lot of people think that when we're investing, we're doing it for retirement and financial independence, but you can be investing for a multitude of reasons. And why it's important to actually really differentiate your different goals is they will all have different criteria. And also they will have separate investment portfolios. You're not just going to invest everything in one pot. You're going to have different accounts, different specific portfolios with different asset allocations for each of those goals. So for my example, using my portfolio that I showed you, actually, do I have that slide? No, I'll just go back to that slide. Okay, just to give you a little visual. So this particular account was for my retirement goal. This is my RRSP. I only used my RRSP for retirement. So that is, why I had a particular portfolio. It had a very particular asset allocation compared to some other goals that I have. For example, I did have, bought a new house. And so that was the goal. General wealth building, that's kind of just a separate goal where I just kind of want to maybe be a little bit more risky with my investments. But it's really important to have specific, clear guidelines and goals before starting to invest your money. The next is your time horizon. So that just means how long are we investing for? So if it's retirement, depending on your age, it could be 20, 30, 40 years from now. If it's a shorter term goal, like your house down payment or something like that, it could be 5 years, maybe even 10 years from now, depending on where you want to live and how expensive the house is that you want to buy. So it's really important to understand not just what the goal is and how much you need for that goal, but also how long do we have to save for it. That'll really have a big impact on what your asset allocation, which is the mix of stocks and bonds in your portfolio. Now, one example I like to give is if you're 30 and want to retire at 60, that's a 30-year time horizon. But if you're 50 and want to retire at 60, that's a 10-year time horizon. The makeup of those portfolios are going to be very different. You can take on a lot more risk if you have a longer time horizon. You should be taking on less risk. So having a higher ratio of bonds or fixed income in your portfolio if you have a very short time horizon. Next is risk tolerance. So that literally means how much risk or volatility in your portfolio can you mentally tolerate, because it really is mental anguish. A lot of people cannot stomach the ups and downs of the stock market. So having your portfolio, which is predominantly invested in stocks. So if you had 100% equity portfolio, there's going to be a lot more, bumpy rides. But if you had a portfolio that was maybe 70% stocks, 30% bonds, the waves are going to be a lot smaller. So it's really important to understand currently where you are right now and how much volatility can you stomach. I mean, that's, I think, a big reason why cryptocurrency is not for me, because if you look at any, Bitcoin chart, the volatility is off the chain. Like it's off the wall. It's crazy. And I'm like, I can't stomach for it. I don't have the stomach for it, but I do have the stomach for, a fairly aggressive portfolio. So it's important. There's a lot of great risk tolerance questionnaires you can check out to determine okay, what is my level? But also I find, working with individuals and also in my own life, sometimes when you're just getting started and you're not super comfortable with investing, your risk tolerance will be pretty low just because you're unaware, you're not comfortable and you're just getting started and you're just not sure about things. And so even for me, my first portfolio was actually pretty conservative just because I was afraid of losing my money basically. But then as you get educated, you get more experience and you just get more comfortable with being an investor, you may actually realize, oh, I actually do have a higher tolerance for risk. And that is when you go into your portfolio and you actually adjust the ratio of stocks and bonds. So that's the other thing to really remember is when you start investing, your portfolio is never, set in stone. You can change it, and you should be changing it. You should be tweaking it so it is always aligned with all of those kind of things: your risk tolerance, your goal, your time horizon, all of those kinds of things. And the other really important factor is diversification, which is just a fancy way of saying don't put all of your eggs in one basket. Don't put all of your money into Tesla stock. Don't put all of your money into bonds. Like, you want to make sure that you're investing in different asset classes. So stocks, bonds, and maybe even some other asset classes such as real estate. And then you also want to make sure that you're investing in different markets. So like the Canadian stock market, the US stock market, developed countries, international stock markets, developing countries, and then also make sure that you're investing in different companies and sectors and industries. Basically, it's really important in terms of basically what's called diversifying away the risk of your portfolio, to invest in lots of different things, because everything works different. Like different countries and their stock markets, they do not all move the same way at the same time. One country may have a crash, but then another country may not. And so that'll kind of balance things out. And so that's why it's really, really important when you're looking into investing to make sure you're investing in a lot of different things. And typically, when you get started, depending on how you're investing, they will make sure that you are diversified. And now I want to talk about how to actually get started and what does that actually look like. So this is kind of a good little checklist. And then we will get to some questions. I'm getting close to time. So the first thing that you're going to really want to do is figure out, okay, what route do I want to take? There's a bunch of different routes, mainly just 3 actually. I prefer the first 2, but I'm a passive investor. That's the strategy that I like to practice. So I'm a bit biased. So number 1, you can use a robo-advisor. So if you've heard of Wealthsimple because they advertise a lot, that is an example of a robo-advisor. Number 2, self-directed using a discount brokerage. So if you've ever heard of DIY investing, do-it-yourself investing, all that means is you're opening up a discount brokerage account. So using Wealthsimple again as an example, they have Wealthsimple Trade. That is a discount brokerage app. That means that basically you are responsible for your investments. You do the buying and selling of securities like ETFs or stocks, but you're in control. You're your own portfolio manager. And number 3, which is kind of the traditional thing that you see like your parents or your grandparents do, using a wealth management firm or a bank, you have an advisor, they manage your portfolio for you. Those are kind of the 3 routes you can take. Next, you want to choose the right account to start with. So ultimately, the goal is to max out your TFSA and max out your RRSP, and then eventually move into a taxable account. That's the goal. But when you're just starting out, the question I hear often is TFSA versus RRSP. Which one should I use? It really depends on what your tax bracket is. Are you in a high tax bracket or low tax bracket? If you don't need a lot of tax deductions right now because you're not at that level in your career, focus on your TFSA. And then when you get to a point where you're like, oh, I need some ways to lower my tax bracket because my tax bill is going to be really high, then you're going to want to focus on putting money into your RRSP. And it's also important to remember you can have multiple TFSAs, multiple RRSPs at multiple institutions. So you can have 10 TFSAs at 10 different institutions if you want. So you're not limited to one location. Next, set up regular contributions, make it automatic. So again, I say it's really important to contribute to your investments regularly. The best way you can do that is to set it up with your bank account, like a checking or a savings account. And so money automatically moves there like every paycheck or every month. Out of mind, it is investing for you automatically. Number 4, increase your contributions as your income increases. I think a lot of people get really stuck, like with that example I gave of if you invest $1,000 per month, it's not that everyone has $1,000 per month at the get-go, but you might, as your career progresses, you make more money, you may get to the point where you do have $1,000 per month or even more, like $1,500 per month. And so as your income increases, don't just let lifestyle inflation happen to you, which just means you just spend that extra money you earn. Do something good for you and invest that difference or invest part of your new salary. So you are, again, increasing the likelihood that you're going to reach your investment goal, and maybe you'll even reach it sooner. And just a few more on the next slide. This is kind of in conjunction with number 4, but invest any windfalls to accelerate your goal. So I see so many people when they get a bonus tax refund, a gift from family or an inheritance, they just blow it. And like, I understand everyone wants to just treat themselves. What I say is like, oh my gosh, just take a percentage of that and have fun with it. But the rest, do something that future you will be so thankful that you did, like investing it. That is the best thing that you can do for yourself. Because again, it's not like you're locking it away. It's people I think often think of like, oh, I want to spend it instead of invest it. It just, when you invest money, it just means you're going to spend it in the future and you'll have more of it to spend. So that's kind of another way to think about it. Number 6, participate in your workplace's pension or group RSP plan if they provide a contribution matching. So this is something I ask every single person I feel like I get in contact to. Is like, oh, you're not investing? Does your work have a pension? Does your work have a group RSP or something like that? If they do, and especially like if they provide matching, there are some companies out there. I worked for one where they didn't provide matching. So I'm like, well, then why bother? Don't do that. Don't participate in that. Like, just invest your money how you'd like to do. But if they do have a pension or a group RSP and they provide matching, what that means is you get free money from your employer. That is money that you would not get from them if you did not participate in that program. It is leaving free money on the table. So look into that and make sure to participate as soon as you can so you can get that money rolling. I can't believe so many places I've worked, I was usually the only person to participate in these programs. I was the one who, left my last job with, several $1,000s extra in my pocket, and so many other people didn't. So it's just like, again, leaving money on the table. Number 7, review your portfolio once per year and make adjustments as your life and your goals and your risk tolerance and your time horizon changes. So like I kind of mentioned earlier, your portfolio and your investment plan is not something that is set in stone. It's not something that's going to be stagnant. It's going to evolve. It's going to need tweaks. So basically, recommendation is once per year, do a review, see if you need to change anything. And last but not least, don't wait until you're ready or completely debt-free before start investing. Even if it's a small amount that you can contribute today, you can't afford a lot. It is still the best thing that you can do. The best, I think there's a quote. It was like that your biggest investment asset is time. So the earlier you start, the better you'll be off, really. So it's really, really important to not wait for the perfect time. It's really about figuring out, okay, like all the kind of steps I shared before, where am I going to invest? How much can I afford, et cetera, and getting started as soon as possible. Again, if I, was able in my mid 20s to contribute $200 per month and I only earned $300,000, I wish, $30,000 per year and lived in the expensive city of Vancouver, you can probably find the money to invest like $50 a month or $100 a month. You can probably figure it out for yourself. And again, future you will be so glad that you started doing that as early as you did. And just to kind of talk a little bit about the debt-free portion. So it's more if you have high interest debt, like if you have a credit card or payday loans, things that are real and also eating up a lot of your monthly cash flow and making it difficult for you to have anything extra to spare to invest, I'd say just focus on paying off those. But things like a car loan or student loans that have relatively low interest, I'd say it may take you a decade to pay off your student loan. So don't wait a decade to start investing. Like you can do both at the same time. And one last thing is my biggest thing is never stop learning. So after this presentation, continue on this journey of investing because it is a journey. There's a lot to know, not to scare you. Because again, my kind of story, which I didn't really share, is I didn't know anything about investing, but here I am talking to you and knowing all these things. So anyone can learn this stuff. It does take time and patience and some effort on your part, but you can do it. And then every time you learn something new and something clicks, you just feel that much more ready and confident to continue to invest and build your wealth and make some better decisions for yourself, in the future. So some examples of how you can get started is got some book recommendations there. Those are some of my favorite books. You can listen to podcasts. I've got one myself. Videos. Be careful with some of the YouTube videos. A lot of them are like hot stocks now. So grain of salt. Articles from like the Globe Mail and Financial Post. Courses. I have an investing course as an example. So really make it, if you're like, I want to start investing, but I don't know how, then make it your priority to learn what you do not know so you feel ready to actually take action. And with that, so first, I just want to share a link to my investing course. It is specifically for Canadians as well. So it's called Wealth Building Blueprint for Canadians. So if you want to check that out, that is the link. It's also just available on my website. You can check it out. And if you have any other questions, you can email me. But this is the Q&A period, so I'm happy to take questions right now. Send me any of your questions. Did you want me to not share my screen anymore?
No, you can leave it up, Jessica. If anyone just wants to come off mute or drop me in the chat, and then you can ask your question live to Jessica.
Is there ever a max percentage that's safe enough to gamble on? I have like 1%, I treat as fun money or crypto. Yeah. So that's actually a great way to think about it. So yeah, generally the one kind of strategy is having what's called a core portfolio. That is where you just, you've got your plan. You're not going to gamble with that. That is for investing. And then you can have a satellite portfolio that can be like a certain percentage of your overall portfolio, or you can be a specific dollar amount you give yourself every year or every month, but it is something that you were okay losing. If you're like, it's okay, I know I may lose this money and that's fine, then that's cool. Percentage, I think in general, it is between, don't go over 10%, or I think like a good sweet spot is about 5%, but it really depends on, your own comfort level. So that's kind of the general for that. Wondering if Wealthsimple Invest is a good option for new investors, or is there a recommendation that you make? Well, Wealthsimple Invest, the robo-advisor. So yeah, I mean, there's tons of robo-advisors. So I always say before jumping in, take a look at your options. There's like a good, like maybe 9 in Canada. If I can list them all, let me see. Wealthsimple, Modern Advisor, Just Wealth, Nest Wealth, or is it called CI Direct Investing? No, Nest Wealth exists, then CI Direct Investing. There's a couple others I can't remember. You can Google it. So take a look at all the different ones. They're all fairly similar. Wealthsimple Invest, particularly, I actually used them for 4 years. I really liked them. So yeah, I'd say, I personally, use them and like them. So I have nothing bad to say about them. Do you follow a general 50-20-30 rule to break down how you allocate your money monthly? I do not. I don't really like very strict rules like that, because I'm also like, where did those numbers come from? They seem kind of random and arbitrary. But it's a good place to start if you don't know how to allocate. For me, I have like a certain budgeting structure. I've got some budget spreadsheets on my website that have videos that show you how to do it. But basically, I like to pay myself first, so focus on my saving and investing first, and then allocate whatever's left to my fixed expenses, and then whatever's left to my variable expenses. But I always have some goals of myself to be like, I'd like to save half of my income for my saving and investment goals. I don't know if that's what I've actually been doing this year. I have to take a look at my budget and see where the actual numbers. It was an expensive year, but I don't really use that rule of thumb for me. I kind of make up my own rules. Let's see. So many great questions. Is it better to have riskier investments in your TFSA or RRSP? I'd say quite honestly, a taxable account, not your registered account. And the reason is, in your TFSA or RRSP, you cannot claim investment losses against your tax liabilities. So basically, if you lose money in your TFSA, like you buy a stock and then it's negative returns, not only, you have lost that TFSA room if you keep it until it recovers, then you're fine. But if you sell it, lock in that loss, you lose that TFSA room that you never get back. But also you can't use tax credit to try to benefit from that loss. So in general, actually, if you want something riskier, I'd probably put it in a taxable account for that reason.
Oh my gosh, Jessica, so much information. Incredible. Thank you so much. Just in the interest of time, everyone, we're going to wrap right now. Thank you so much for your incredible advice. If you have any lasting questions, just email Jessica. Jess, is that okay if they email you?
You can email me. You can DM me. I try to do, I'll have to get back onto it, but I think tomorrow I'll do an Instagram AMA. So you can find me and I can answer your questions. Happy to.